Today is Wednesday, 4th of June 2025, 6 a.m. Eastern Time. This news is brought to you by Preeti Capital, your trusted source for financial insights.
Okay, let's get into it. Welcome to the deep dive. Today, we're taking a close look at the financial markets. We've got the latest data here from Wednesday, June 4th, 2025, and some interesting insights, including from Preeti Capital, that we'll use to sort of try and figure out what the market's really telling us. The goal here is simple: cut through the noise, see the big movements, understand what's driving them, and what the signals are for the economy right now. And honestly, the signals today are pretty fascinating. You've got this clear strength in areas like tech, but then there's this backdrop of global uncertainty that just won't go away. And maybe most interesting, this kind of split, this divergence happening in bond yields. It seems like a different story brewing there.
It really is a complex picture. Definitely a balancing act for investors at the moment. We're ready to guide you through it.
Great. So let's kick things off with the stock market, just the overview. Generally, things looked pretty positive today, didn't they?
They did, yeah. The major indices, your S&P 500, the Dow Jones, they both finished higher. Maybe not huge gains, but definitely positive.
Shows some continued optimism, maybe.
Exactly. It suggests that underlying confidence is, well, it's still there. But the really big story, I think, in stocks today was technology. No question.
Right.
We saw a pretty significant rally there. The data we have points to strong earnings coming through, positive forecasts from some of the key tech giants, and that just really seems to solidify investor belief in their growth potential down the road.
Which explains why those tech-heavy indices really outperformed today.
Precisely. They were the clear leaders.
Okay, and what about beyond the biggest companies? The Russell 2000 index that tracks the smaller ones, it surged today quite significantly. What does a jump like that usually tell us?
Well, a big move up in the Russell 2000 is often read as investors having a renewed appetite for risk. They're feeling confident enough to move into potentially more volatile, but maybe higher reward smaller companies.
So maybe feeling better about the broader economy, not just the mega caps.
It can signal that, yes, a sign they feel okay taking on a bit more risk beyond just the established leaders.
And talking about risk, or maybe the lack of perceived risk, the VIX, the
What's
fear
that?
index,
Ah, yes, the VIX.
it showed a notable decline today.
It did. And the VIX, it measures the market's expectation of volatility in the near future based on options prices.
Hmm.
So when it drops like that, it typically means investors are, well, less anxious. They're anticipating less choppiness ahead.
What drives that? Positive data, central banks.
Could be a mix of things. Recent economic data might look good, or maybe there's a feeling that central banks, like the Fed, are providing a sort of safety net. It points to less worry, short term at least.
And this positive feeling wasn't just here in the US, was it? Looking globally.
No, definitely not. The data shows European markets like the FTSE in London, the DAX in Germany, they were up. And over in Asia, Japan's Nikkei, Hong Kong's Hang Seng, they saw pretty solid gains too. Even Shanghai finished a bit higher.
So a kind of broad-based positive sentiment.
It does suggest that, yes, a general sense of maybe economic resilience and optimism spreading across regions, not just isolated.
But there's always a but, isn't there?
There usually is.
The data is also very clear. Global uncertainties are still very much in play.
Absolutely. Things like geopolitical tensions, trade policy discussions that are still ongoing, various regional conflicts, and none of that has vanished. It acts as this, critical undercurrent. It injects caution, especially in sectors that are heavily exposed internationally, keeps things from getting too euphoric.
Okay, so let's synthesize that stock market picture. Strong overall, definitely led by tech, supported by signs of broader risk appetite like the Russell 2000 and the lower VIX,
Right.
but all happening within this global context that's still, well, uncertain. So a mix of optimism and caution.
That sums it up nicely. You see very specific strength, like in tech, which seems almost unstoppable sometimes. But investors are clearly still keeping an eye on those broader risks that could easily, shift the mood.
Okay, right. Now let's pivot, because while stocks were mostly green, the bond market, that seemed to paint a much more nuanced picture, maybe even contradictory in some ways.
It certainly did. Bond yields are often seen as a more direct reflection of what investors expect regarding inflation, economic growth, and crucially, future interest rates from central banks.
Like the Fed.
Exactly. And the way yields move today across different time frames, different maturities, was quite revealing.
Let's look at the numbers we have. The benchmark 10-year Treasury note yield, it ended the day at 4.46%. but it actually saw a slight decrease, down about 0.0448%. What might that little dip mean?
Well, even a small decrease in the 10-year yield can suggest a few things. It might mean a bit more demand for that particular bond. Maybe investors are seeking a little more safety compared to other things. Or perhaps there's some cautious optimism about stability that makes that fixed return look okay.
Could it also hint at future rate cuts, even slightly?
It can sometimes factor in, yes, if there's even a tiny shift in expectations towards future cuts. It can make locking in today's longer-term yields seem a bit more attractive, nudging the yield down. It's subtle, though, at that level.
Okay. Now, contrast that with the really short end, the 13-week Treasury bill yield. That one rose today, up about 0.07% to 4.235%.
Right, so the opposite direction.
What's driving yields up at the very short end?
Usually, a rise in short-term yields like that reflects expectations about near-term interest rates.
Hmm.
The market might be pricing in the idea that the Fed, for instance, will keep rates where they are or maybe even hike them in the very immediate future. It could also be related to, supply and demand for those short bills or investors just wanting to stay liquid, keep their cash very short term while they figure things out.
Okay, short end up, middle slightly down, and then the really long end, the 30-year Treasury bond. That yield saw a much bigger decrease. It fell roughly 0.24%, ending at 4.983%. That feels like a significant move.
It really is quite notable for the 30-year. A drop like that signals very strong demand for those super long duration bonds.
Why would demand be so strong there?
Well, remember, bond prices and yields move inversely. High demand pushes prices up, yields go down. So strong demand could mean investors are trying to lock in those yields for the very long term, maybe because they expect rates will be much lower years and years from now.
Or maybe concerns about long-term growth, a flight to safety.
That too. It could definitely reflect a flight to quality. If investors are worried about economic growth prospects way down the line or other big uncertainties, they might pile into safe, long-term government bonds, looking to secure that yield for decades.
So let's recap the yields. Short-term rising, 10-year slightly dipping, 30-year dropping significantly. This divergence, this bifurcation, it really paints a split picture, doesn't it? What's the story when the curve moves like this?
It's fascinating, and yeah, it tells a complex story. On one side, you've got rising short-term yields. That could be the market saying, okay, for right now, maybe the next few months, we think rates stay high.
Hmm.
But then falling long-term yields suggests something different for the future. Maybe growing concern about economic growth slowing down eventually. Or maybe it's growing confidence that inflation will eventually fall, allowing rates to come down significantly over the long haul.
So it's like the market has two different views depending on the time frame.
Almost exactly. It's like one forecast for the immediate term, maybe higher for longer on rates, and a different, more cautious or maybe rate cut expecting forecast for years down the road.
Bond yields really are this critical barometer then. Today just highlights that push and pull investors are dealing with.
Absolutely, they reflect that delicate balance. Yields get pulled by domestic things, rate expectations, growth worries, but also by those same global uncertainties we talked about with stocks. It's a constantly shifting.
Okay, so let's try and connect these dots. Bring the stock and bond pictures together. We have this, well, pretty impressive strength in stocks, right? Especially tech, small caps surging, suggesting risk on, confidence in growth.
Yes, the equity market seems quite buoyant in those areas.
But then the long end of the bond market with yields falling significantly, that often signals caution about the future, right? Or anticipates lower rates.
That's the typical interpretation, yes. Lower long-term yields often suggest concerns about future growth or expectations of easing monetary policy down the line.
And all this is happening against that backdrop of global stuff still lingering. So how do these seemingly conflicting signals coexist?
Well, that apparent conflict is what's really noteworthy today. The stock market, or at least parts of it, seems to be shouting, growth looks good, let's take some risk. Meanwhile, the long end of the bond market is maybe whispering, hang on, let's be careful. There might be bumps down the road, maybe a slowdown, maybe policy shifts that bring rates down.
So it shows investors aren't all thinking the same thing, or they're weighing different factors for different time horizons.
Exactly that. It highlights that investors have different views, different priorities, and are looking at different time frames. The tech investor focused on near-term earnings growth might feel different from the pension fund manager trying to lock in 30-year returns.
It really underscores the complexity we started with. You've got this really visible strength, especially in tech, almost celebrated.
Right.
But underneath, there's this tension from global factors, yes, but also critically from the bond market seemingly pricing in a less rosy long-term future than stocks are right now.
It means investors are navigating with this blend, this mix of optimism about the present, or certain sectors at least, and caution about what lies further ahead.
And for you listening, understanding this divergence, this isn't just academic, is it?
Not at all. It helps you make sense of the financial news you see. You can understand why some headlines might be bullish while others sound cautious. It shows you those competing forces, the excitement about what's driving growth now versus maybe deeper concerns about the long term or about where interest rates are ultimately headed. It gives you context.
Okay, so wrapping up our deep dive for today, June 4th, we saw a stock market generally positive, definitely fired up by tech strength. We saw broader optimism hinted at by the Russell 2000 surge and the VIX falling.
But tempered by those persistent global uncertainties.
Exactly. And then, crucially, this striking divergence in the bond market. Short-term yields up, suggesting maybe rates stay higher near term.
While long-term yields drop notably, signaling potential caution about future growth, or perhaps an anticipation of lower rates way down the line. A very mixed message there.
It certainly leaves us with something to think about.
It does. And here's maybe a final thought for you to consider. Given these opposing signals, the stock market's bullishness, especially in tech, versus the long-term bond market's caution, shown by that yield divergence. How might you read the underlying economic outlook? What does that specific split in yields tell you about the market's real confidence in future growth versus how much it's anticipating policy changes or just needing long-term safety?
A lot to chew on there. Definitely something to keep in mind as you look at the markets tomorrow.